That's a nice return. Do this times 12. Now you have annual cash flows of $29,500. That's incredible. Sweet deal. Well, hey, this is Greg Cullen with Leverage Hustle here with another mentorship series with Dennis and Val. I'm super excited about this episode today. We're going to be doing a little bit more deal analysis. I know they had specific questions on house hacking, out-of-state investing, and really just jumping to the first deal itself. So, Dennis, Val, great to see you again. How's the start of your day going?
Thanks, Greg.
It's
great
good.
to see you too. Yeah, it's going really good. Excited. Actually, really been looking forward to this call all weekend. We had a lot of questions, a lot of things that were like, all right, that's a question for Greg. We got to put a pin on that.
Definitely. I've been doing a ton of research, trying to figure it out, exploring different forms of creative finance. Subject to more specifically. So we've been just trying to figure out all different avenues and just educate ourselves.
Yeah.
Good stuff. Well, I'm super excited for this too. I know we talked about some of the questions you guys had, and I think this is going to be a fun conversation. So with that said, I'll let you take control. There were a few things on top of your mind. Where do you want to start first?
Yeah, I think a good place to start is maybe just validating some of the math that we did on some of these out-of-state properties. I know that there's a lot that goes into out of state. This is our first investment property that we're looking to do. I know from our research, it's said rule of thumb is try to do it in your backyard, but with high interest rates, it's kind of hard to make that work. So we're trying to find different cities around the country where the math does make sense. Charleston, South Carolina seemed like it was one of those. So maybe we could jump into that property and tell us if we're crazy or not.
Sweet. Let's do that. All right, let me, you sent it to me in advance, so I'm going to pull it up now. I'm also going to share my screen too. So for those watching, they can see what is going on behind the brain. All right.
Awesome.
So I had this one here. We're looking at 1540 Seacroft Road, Charleston, South Carolina. So already looks like a nicely done property. Tell me about your thoughts on this. Why did you choose this one, and what were the numbers you got at so far?
So we have talked to people and just heard kind of, around the mill that Charleston, South Carolina, and South Carolina in general is kind of becoming a hotspot for real estate investors. This is, in our conversations, you've talked about a lot of the big cities. Sometimes the math doesn't really work out, but looking 20, 30, 40 minutes outside of those cities, those people are still commuting into the cities and families are setting up shop. So kind of took all that into consideration and found this property that kind of fits the buy box, and ultimately try to run the numbers, look at some comps. I think you had taught us to look at what are the houses kind of going at around it, as well as flipping it and doing the rentals and saying, all right, what are the 4-bedroom, 3-bathrooms we're renting for? And if you could make the math work out. So that's what we looked at. I'm trying to remember. I think
also too, just it was definitely a very turnkey property, so it didn't need a lot of renovation. And then also too, the location made a little bit of sense based off of, school zone, growing area, and so forth. But
that's right. I think we did. I think we used ChatGPT and then plugged in and asked about the school zones in that area, and then you can see what they're rated. And I think the schools were rated like 8 out of 10 using I forget the websites, but
it's nice that you have so much water access. I mean, people can literally go to the island, go to the beach. They can do whatever they want. You could probably use this location for long-term rentals. I don't know about midterm, but maybe even short-term, since you're so close to everything. I mean, that might be an interesting thing to do. So it's fully renovated, 4-bedroom. That's fantastic. 5 minutes from the beach, 10 minutes from downtown. That's incredible. All new flooring, new recessed lighting. That's fine. New fridge, stove, ceiling fans, HVAC 5 years old and is just serviced. No HOA 2. So the good thing about this is it is pretty much turnkey. Exactly what you said, Val.
And also, is that an indicator that maybe there's not a lot of people renting in the
potentially.
area?
I mean, I generally like just typing this in to see how fast cities are growing. So boom, right there. They have a 1.5% increase. So that's pretty nice. When I'm looking for a place, I generally want to see a population growth anywhere between like 1 to 3%. That's pretty ideal. Places that just sprung up quick, like Boise, Austin, Nashville, other places like that, they've also come down pretty consistently. Charleston is consistently growing. Charleston is a great town to be in. Have you guys used Rentometer before? Are you familiar with that?
Yes, I think I ran out of the credits.
I ran out of it myself too. It's a bummer. So this would have to do more due diligence. I wouldn't just say do this deal, but like definitely do more investigation. But let's just hypothetically say that you can rent this property out for $4,000, and I'm going to discount this at 38 because the outside looks. It's kind of tough. Like I want to discount this because the photos on the outside look like shit, but they also have a garage there. The inside looks really nice. Man, it's kind of tough. I think this property that you are evaluating is definitely going to be between like 38 to 4. So let's just base it off of 30. Let's meet in the middle. Let's just call it 3,900. 3,900 minus 3038. It's $862 a month times 12. That's $10,344 of annual cash flow each year. Now, you're putting down $85,000 in this house. I'm expecting it's going to be pretty much turnkey. I don't think you need to put down any additional money into this house or renovations, but you're going to have to put down closing costs, and that's generally 1 or 2%. So add on, call it another $8,000 to this. 2% of that is another $8,000. So that'd be $93,000 total in. You're sitting at about an 11% cash on cash return. It's pretty interesting. Now that's for long-term rentals. Now we're not even taking consideration short-term rentals in Charleston. I think Charleston is a great place to be. Let me see if I can find a couple resources. Let's base it off 30 days a month times 74%. So you're gonna rent out for 22 days a month for $250 a day. That's $5,500. So you're able to juice out a little bit more of the returns. Now, $5,500 times 12. Wow, that looks nice. Let me go back to this. All right, so we were at $5,500 total. Minus 3,038. That's a nice return. Do this times 12.
Yeah, I like that.
Now you have annual cash flows of $29,500. That's incredible. Now, think about it. So your down payment and closing costs are about $93,000. Now you have a 4-bedroom place that you're going to need to furnish. Maybe you would spend as little as 10, maybe as much as 20, maybe a little bit more. Maybe say you're going to spend $15,000 on the place. That might sound reasonable. You need to get 4 beds. That's, probably $4,000 for the whole sets and all that stuff. Then you need to furnish on top of that. So let's just say that's another $15,000. So 93 plus 15, what's that? 108, give or take. So let's just run it up to 110
something like that
to be safe.
Cool.
You're looking at about a 27% cash on cash return. Sounds like a
triple.
Sounds like a really nice triple. Yeah. So this is a really interesting one because you can make a lot of money, and you'd still have to do your proper due diligence and buy your license at Airdina and make sure you run your numbers very conservatively. You need to budget for the low times of the year. You also want to budget for the high times of the year. Now, when we bought our place in Maui, we just budgeted for the low time always. We budgeted, I think the average was like 80 or 85% occupancy, and we found other people that were hitting like 90 or 95% occupancy. We budgeted based on, I think, 75% with a daily nightly rate of like 200 or 220. And we got to a point where we were like 95% occupancy with our daily nightly rate of like 260 to like 280 in that range. So our numbers went way up.
Okay.
Cool.
Any other questions on this one before we move on?
No, I think that's great.
Yeah.
Cool. Well, we are marking that one as good.